Kristen King, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. This week, we're looking at a set of themes that are gaining momentum across the globe, becoming an increasingly important factor in investment decision-making. ESG, which stands for Environmental, Social, and Governance. ESG has its roots in the environmental and climate lobbies, but it has grown to become a far wider set of standards that also encompass ethical and social issues and not just concerns about the scale of our carbon footprints. To date, the U.S. has lagged behind Europe on some ESG issues, though Joe Biden's decision to rejoin the Paris Climate Accord just hours after he became president suggests that the environment will be far higher up on the agenda under the new administration. According to data from fund research house Morningstar, as of August 2020, there were more than $1 trillion in ESG-focused funds around the globe. That figure had grown to $1.2 trillion by the end of October 2020. Fund flows into ESG investment were growing by 14% in the third quarter of 2020, and research by the Financial Times suggested that funds managed with an ESG bias could overtake traditionally managed funds by 2025. That might sound unlikely until you consider that fund managers such as BlackRock, the world's largest asset manager, are putting ESG considerations front and center. BlackRock CEO Larry Fink made that very clear in his 2020 letter to CEOs, where he said that he believes that the pandemic has presented such an existential crisis, such a stark reminder of our fragility, that confronting climate change is now a primary concern of his. So, what issues does ESG investing address and attempt to change? The first issue is, of course, the climate and the way that businesses and individuals treat the environment. Fossil fuels and industrial processes that generate greenhouse gases or otherwise damage the environment are the principal targets. However, ESG investors believe that every company and business should look at their operations from top to bottom to see how they can reduce energy consumption and emissions and the level of waste that they generate. That ties in with another of the ESG goals, that of sustainability, and the idea we cannot continue to consume the planet's finite resources, and that instead we must look for ways in which we can consume less and recycle more. Renewable energy led by wind and solar power generation is at the forefront of sustainability, and of course, the move away from combustion engines to electrically powered vehicles is another example of where ESG themes are driving investment decisions. For example, Ford announced last week that all of the cars it sells in Europe are going to be electric by 2030, and that it would invest $1 billion in an upgrade of a plant in Cologne, Germany, to facilitate that change. Away from the climate and environment, ESG investors are also looking at the social aspect of businesses, including issues around diversity and inclusion at the board level and throughout businesses as a whole. Norway's $1.3 trillion sovereign wealth fund recently said that businesses where women make up less than 30% of the board should set targets for better gender diversity, and that the fund would target businesses that have 2 or less female directors on the board. The implication is that they would lobby for change and even vote against those boards unless they could explain the lack of diversity. ESG investors want to see that businesses are making ethical choices, monitoring their supply chains and the conditions that workers within them are exposed to. Businesses are now expected to produce annual reports that quantify how they are performing in terms of ESG issues and what steps the management is taking to address them. A whole industry has now sprung up to score and rank the performance of big business on ESG issues, and these ESG scores can directly influence a decision to invest in a business or not. Increasingly, retail investors are looking at ESG ratings when they make investment decisions, particularly where they are investing in funds. For example, ETFs are regularly ranked on their ESG performance. The largest ESG ETF is the Utilities Select Sector SPDR Fund, XLU, with $11.41 billion in assets. And according to Trackstar IQ, our proprietary search tracking tool, 12 institutional investors have been researching this fund in recent weeks. What's more, the sectors that have been at the forefront of the rally of U.S. equities over the last 11 months, for example, technology stocks, are also stocks that rate well on ESG metrics. So you may have already benefited from these trends without even realizing it. ESG is not going away, and its themes will play an increasingly influential role in the way that business and investment are conducted, and they could ultimately decide which businesses get funded and which don't. That's all we have time for this week. Remember, make sure you do your own due diligence before making any investment decisions. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.